We've moved up somewhat. I think that when we look at this year, we look at a year in which we've had 25% growth in earnings. The second quarter, the third quarter, S&P 500 companies have both grown earnings per share 25%. The market's only up 6%. So could it have been higher? Probably. If the market were moving up commensurate with the earnings, we would see a higher move. But as far as what's going on today, these are all positives for the market. It relieves some of the pressure that was on the market. I think they're good news for the market. And we think that this could be a good catalyst going forward to continue to move us higher.
How lasting, Ben, in your view, is this catalyst of this trade détente? I mean, how long do you think this could last? And will we see the sectors that led us higher throughout the year continue their rise if there is some sort of year-end rally?
I think, Melissa, we see this as one of three partial resolutions to major headwinds that the market's been experiencing. Last week, we saw the Fed with some light at the end of the tunnel as far as the tightening cycle. In addition to the trade issues today, you guys talking about oil, and it seems like OPEC's going to at least keep production at these levels, and the oil price won't plummet. So that's good. I think that the trade issue looks like a little bit of a kick the can down the road, but there might be some resolution of key issues within the next 90 days. If not, that'll be disappointing. But I think when we look at what's happening with the economy, we're slowing down to still high growth rates. I think the sectors that'll do well in that kind of environment, I think this expansion is very much reliant on capital spending by businesses, continue to advance into 2019. So in that context, technology, industrials, and then with the strong consumer, we think consumer discretionary will do well.
Going back to this question about whether that sell-off is over and we're moving past this now and it's the trade talks and that's, I mean, is this really all about the Fed and those comments from Jerome Powell turning things around and saying, you know what, maybe we have done enough, maybe we don't need to get more aggressive? It's confusing because now if the picture looks brighter, maybe he comes back into the picture. How much is the Fed at play here?
Well, I think, Kelly, the big issue is the Fed, for the first time in our history, has been tightening it to a non-inflationary environment. The economy was growing reasonably strongly due to the tax reform in 2018 here, but it's going to slow down. And without inflation, I think that that's very important, the sense that they're near the end and they're not going to over-tighten. I think that was the biggest driver of last week, and it'll probably continue to be the biggest driver of the market and prevent the multiples from contracting more.
At the same time, I mean, even if they don't, quote unquote, over tighten, they tighten one more time, and it looks like we're in jeopardy of inverting the yield curve at this point. And the difference between the 2s and 10s today reached 17 basis points. So we're stone's throw away, and we're seeing the reaction in the financials, particularly the regional banks. So are you concerned about that, being an impact?
Well, I think that there's certainly some concern that continues to hold the financials back. We happen to like financials. We think that they're way undervalued. There's a lot of value there for longer-term investors.
Isn't it frustrating, though? They seem to be held hostage to the yield curve? It's
very much held hostage to the yield curve. And with the 10-year at 3%, that's a harder environment for them to really increase their earnings per share going forward.
Sub-3, by the way, Ryan. Sub-3 today.
Well, but on the other hand, what you have is, going into next year, these companies continue to do a lot of things with their excess capital. These are companies that are in a better position than they've been in many years. They have a lot of excess capital. They have cash they're using for stock buybacks, and a pretty significant amount for stock buybacks and dividends. So I think it is going to be a longer-term process to get us to a better interest rate picture, which will help them. But in the meantime, there's still some good support there.